Today, we are going to build a profitable, data-backed dividend portfolio right here on screen. We're skipping the basic theory and moving straight to the math that actually generates cash. But before we pull up the data, we need to clear up the biggest misconception on the internet. Dividends are not free money printed out of thin air. This diagram shows exactly how the ex-dividend date works. If you have a stock trading at $105 and the company announces a $4 dividend, that cash has to come from somewhere. On the ex-dividend date, the stock price drops to exactly $101, and that $4 cash difference is handed directly to you. The stock price drops by the exact amount of the payout because the cash has literally left the company's balance sheet. The business generated $4 in profit, and there are only two paths for that cash. It either goes back into the business for reinvestment, or it gets distributed to the shareholders. Dividend investing is about taking the power of profit allocation away from corporate management and giving it to you. You get to decide exactly how that cash is used. If you look strictly at historical spreadsheets, growth index funds typically outperform dividend funds. That is the mathematical reality. But investing isn't done in a spreadsheet. It happens in the real world, where human emotion and psychological breaking points dictate your actual returns. This graph tracks Meta's price swings over a volatile 5-year period. If you bought in at $166, you would have watched your shares climb to $380 and then crash down to $90 a share. Eventually, it rebounded near $300, but you had to survive a massive 75% drawdown to see it. Data shows that roughly 2/3 of investors panic sell during these steep drops. When the screen bleeds red month after month, the natural human reaction is to hit the sell button, locking in devastating losses. A dividend portfolio provides a steady stream of tangible cash landing in your account every single quarter, regardless of what the daily stock ticker is doing. You get paid even when the market is down. While growth companies offer higher ceiling returns, dividend assets buy you the psychological stability you actually need to stay in the market during a crash. Let's apply this practically. Open your stock screening tool of choice, and we will build a live query to find reliable payouts. This database interface shows our starting point. Step 1. We set our dividend yield to greater than 3%. We want to ensure our cash outpaces the return of a standard high-yield savings account. That gives us an initial list of over 110 companies. A high yield can be a trap if the stock price has recently collapsed. Step 2. We filter for consistency. We require the company to have paid out at least 1,000 crores in dividends for both the last year and the preceding year. Instantly, our list drops from 110 down to just 16. Step 3. We filter for profitability by setting profit after tax to greater than 0. We have to verify the company is paying its shareholders from actual earnings rather than taking on new debt to fund the dividend. Step 4. We look at the price-to-earnings ratio. We require the PE to be less than the industry average. If we overpay for the stock up front, we lower our effective yield on the investment. Step 5. We apply a discount filter, demanding the current price is down at least 20% from its 52-week high. This maximizes our entry point yield and builds in a margin of safety. By layering these 5 mathematical constraints, we strip away the market noise. We are left with a highly curated list of sound, sustainable income generators. Mathematical screening is only the first half of the process. To protect yourself from bad investments, you must do the manual, qualitative research. This document is a corporate dividend policy. You can find this by navigating to any company's official investor relations page. You are looking for explicitly stated rules, like a commitment to pay a minimum annual dividend of 30% of profit after tax. However, a high percentage payout policy is useless if the company's core profits are shrinking. Scrolling down to the multi-year profit and loss table, we look for steady growth. Here, we see a 19 to 20% compound annual growth rate. Checking the last 3 to 5 years of a company's P&L statement confirms that the business is expanding. As the profits scale up, the cash available for your dividend scales up right alongside it. A mathematically screened stock is safe only if its corporate policy explicitly protects the payout and its long-term sales growth actually funds it. If you are looking for an overnight lottery ticket, this system is not for you. The most successful investors treat dividend portfolios as multi-decade projects. True wealth generation requires holding through market cycles, steadily accumulating shares. The math gets highly aggressive when you take those quarterly payouts and immediately reinvest them into more shares. Over a 4 to 5 year timeline, this creates an accelerating, compounding loop of income. These charts track the historical performance of mature companies like Coal India and Hindustan Zinc. When dividends are reinvested, the returns compound dramatically, pushing the compound annual growth rates up to 17% and 40% respectively. Now, I have a homework assignment for you. Go research the current taxation rules for dividend income in India and drop your findings in the comments below. True financial independence isn't achieved by frantically timing the market. It is built by systematically acquiring high-quality assets that pay you simply to own them.